do you have higher premiums, or do you have so much damage and headaches that you're like, screw it, I don't want to be here anymore?
Hello, and welcome to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I am Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're hosting the conversations you won't hear anywhere else about how to make housing more innovative and attainable.
We're really proud to partner with Built Rewards to bring you these smart conversations. If you have an idea for a guest or a show or have an interest in sponsoring an episode, please email us at podcast@thehousinginsiders.com.
And if you like the show, please review, spread the word, share our episodes so we can make more of them and bring you this content.
So we have an incredible guest today. Excited to dive in. Our guest is Ivy Zelman of Zelman Associates. I don't want to go through her entire resume, which is incredible and impressive, but I will say the thing that's most impressive to me is her reputation for seeing around corners. Oftentimes, I've heard her go against consensus opinions of what's going to happen, and then she's proven right time and time again. She's always recognized as one of the most influential people in the world of housing and finance for very good reason. We're completely thrilled to have her on the show today. Welcome, Ivy. Great to see you again.
Thanks for having me. Excited to be on.
Thank you, Ivy. One of the things that John mentioned that keeps coming up is this track record for predicting future trends. You know, you're known for it. And I thought we would start there. So let's start with the big question. What do you think is one of those future trends that people aren't paying enough attention to?
It's a good question. I think that a lot of the industry is not paying attention to some of the headwinds that are already prevalent from climate change, and whether you believe it's man-made or just God doing whatever, or whatever higher power is creating the different types of climate change that we're seeing, I think that it's definitely impacting housing markets significantly and changing how homeowners are thinking about their current living situations. And we're seeing that with Florida, definitely most prevalent there, Texas, Carolinas. I was just reading an email between a colleague and a land developer, and talking about how insurers are now not willing to insure new developments because of the risk that their infrastructure won't withstand hurricanes. So I think that's a bigger issue than many of the industry executives in the public markets want to at least address when I ask the questions. And they're always like, well, we build inland and we're not going to be impacted. And we feel very good about the infrastructure, let's say, the type of construction they're doing that could withstand, hurricane winds, et cetera. So that's something that I think a lot about. I think about the Sun Belt and migration potentially back toward the center of the country and benefiting some of the more affordable markets at the expense of the more expensive markets that benefited from significant migration from north to south or from east to west. And so that's on my brain, and I've been talking a lot about it. But I don't think it's on the top of the list of many of the people participating in our industry today.
Hey, man, I think you're speaking our language as Midwesterners who have often talked about the fact that, Michigan of all states is the one place that has zero climate risk. So stands to benefit from some of that migration. I'd be curious to, just to bite on that topic a little bit. In the Sun Belt, and I've actually heard a couple of nightmare stories of people whose insurance has gone up $1,000 a month. I mean, just really incredible increases in insurance. And there's only so much you can raise insurance prices on the coast. You have to start raising it elsewhere to make up for it. So before digging into is insurance a solvable problem, which it may not be, the outmigration of some of these areas is something I'm really curious about. So I'm living in Florida, hypothetically, I've got a 3.5% interest rate and my insurance costs are going up. At some point, insurance costs are going to force me to move. And I'm curious, is it going to be a breaking point that we're going to reach because insurance costs have gone up? Or is it possible that, everyone's sort of stuck in their low interest rate mortgage? When rates kind of drop to some point, do we expect suddenly there to be a massive outmigration of some of these high cost insurance markets? Does that question make sense?
No, absolutely. And I think that we're seeing listings rising at an accelerated pace in, let's say, Florida markets more so, and in Texas markets more so than the nation. Right now, across the U.S., existing inventory is up about 25%, roughly, a little less than that year over year. Still well below COVID levels. For example, I think Cleveland is up 6%. But in markets that are in MSAs in Florida, north 70, 80, 100%. And what you're likely seeing, in my opinion, is more of those second home investors that are listing homes than the primary necessarily. But I do think that the cost of capital is up substantially for many. That if you are an investor and you're holding several properties, or you're an institutional investor, maybe you're pruning your portfolio, not only the cost of capital, but obviously the cost of insuring your homes, assuming you're an investor. And if you're a second homeowner, you're like, you know what? It's just too expensive to hold this asset. So we have a difficult time ascertaining who the sellers are. And yet talking to realtors anecdotally, they think it's more the non-primary sellers to begin with. But the frustration is building anecdotally from homeowners that are dealing with damages, are dealing with trying to get insurance. And insurance is up exponentially in many Florida markets. And let's just say many can't even get insurance. We had farmers exit the state. We had State Farm exit. Citizens, which is the state-ran insurer, can go bankrupt. I mean, the idea that taxpayers are going to fund this, I just don't see a way out for the insurers. And at the same time, to your point, John, they are raising premiums across other markets that are not affected to the same extent or at all, because they have no choice in order for their businesses to remain solvent. So it's a real problem. And it's not just residential that we're seeing the insurers raising premiums on. You're also seeing that in CRE with multifamily, definitely impacted on new development and on renewals on existing properties. So it's a headwind. I just pulled up some data that I thought was interesting. I presented at the HBA in Cleveland a few days ago. And what we show is that in 2024, roughly a homeowner as a percent of their income is spending on average about 4% today nationally on insurance, homeowners insurance. And yet that compares back to just, let's say 1995, 2%. So, when you start to look at insurance, property taxes, obviously your mortgage payment, all the factors that go into, what comes out of your wallet, insurance is just another incremental headwind that is probably not enough to send them to a new market. But do you have higher premiums, or do you have so much damage and headaches that you're like, screw it, I don't want to be here anymore? And I'm originally from Ohio or Michigan, and I'm just going home. I've had it. And by the way, it's freaking gorgeous here in November in Ohio, and it's getting nicer and nicer, and the winters are getting less severe. So that's our benefit. And, people are like, oh, you live in Ohio. I'm like, yeah, it's pretty awesome. So I think that there is a shifting sentiment towards housing, and I think it's going to accelerate. And assuming we don't have any more storms or there's no more damage, again, not being a climate expert, what I'm told is that there will only be more, severe storms in our future by climate experts, but that's very controversial. So we will leave it at that.
One of the tensions that we bring up a lot on this show that you just mentioned is this tension between home builders, housing finance, which work on 30-year credit cycles, which work on these big, long trends. And consumers increasingly, and technology increasingly, is working on very short trend cycles. People and technology are moving faster than ever to make decisions, to share information, things you mentioned regionally. What are some of the things you look for?
I think what you're saying when you think about AI and just technology today and the speed of getting someone, for example, approved on a mortgage application, that is definitely one of the areas where we're seeing technology really benefit mortgage originators. But as it relates to trends, I think that, the social media platforms today provide people information instantaneously. And so where you have the risk that today consumers are flagging concerns like, i.e., climate change, or that becomes almost instantaneously an issue and everyone's seeing it, whereas in the past, no one may have seen that. But I think that having a 30-year fixed mortgage and long duration housing fundamentals doesn't necessarily match with respect to ability to have a liquid market, in and out, like other markets that are functioning properly, like the stock market, or just having liquidity. When you're in an asset that you're locked in today, roughly 77% of homeowners that have a mortgage are locked in below 5, and something like 50% are locked in below 4. So that does create a stuck factor. So irrespective of what's happening for technology or what is available via social media of information, that keeps people stuck, and they might want to leave, but there at some point, that decision becomes more about lifestyle and what they're dealing with day to day. So I don't know if that helps frame it, but I don't think that we have anything via technology and information flow via AI that's going to quickly unlock those 30-year stuck factors or people in those mortgages.
And so without, for instance, because that was exactly kind of what I was getting at, without sort of a global event like a pandemic, we're not going to see massive fast movement necessarily, meaning the trends we saw around people escaping California, let's say, to Austin, or creating a crypto haven in Miami. Those are sort of tiny PR related trends and not actually the fundamental trends we're trying to get a handle on for what you just mentioned about climate risk and some of these massive levers for people moving around the country. Is that an accurate way to kind of frame that?
Yeah,
Or do we
I
think
think you're right.
people will move faster?
Well, like look at Ventura County right now, that's on fire. And people that are in that market, are they going to move, further away from Ventura, or are they going to leave the state because they're tired of the fires, they're tired of taxes, they're tired of a number of factors? I don't know that it happens all at once. So I'm more in your camp on that. But something like when we were all waiting and bracing, was it Milton or Helen? I don't remember which one, but my daughters are in Florida. They go to University of Miami. They were coming home for fall break or like get on a plane. We thought the Florida was going to get blown away, and it was obviously much less severe. I think something of a major storm that would have been much more catastrophic could create more of an exodus. But what we watch is simply for sale signs. And that's really the indicator of what's happening. I mean, you could do consumer surveys, but really the actionable item is people listing their homes and seeing those for sale signs become more prevalent.
This episode is brought to you by Built Rewards. Built is a rewards program, just like an airline program that is centered around your home and neighborhood. But instead of earning miles for flying, Built rewards you for paying rent, no matter how you pay. As a member, you can earn points at over 20,000 local restaurants, local merchants, and those points are now the most valuable rewards currency. You can use it to book travel, on Amazon, or even towards a down payment.
Built is revolutionizing housing. If you want to learn more, email John at lawless@builtrewards.com.
We're sitting here just after the election, so we have a lot to sort of dig into in terms of what sort of federal policy might look like. But I want to keep talking about this topic because, again, Jeremy mentioned that this is something that we've been pretty obsessed with, which is, what are some of the cultural demographic trends? And I agree, these are things that don't happen over a couple of years unless there's a burning platform, as you indicate. They're trends that happen over decades, but still, nonetheless, they're interesting to watch. I'm curious to get your thoughts about what exactly happened in that sort of moment of the pandemic, because that's we saw incredible amounts of movement, changes in home prices. Is that people wanting to move out of their parents' basement because now they need to go somewhere else? Are they trying to find more space because now they want to have an office? And of course, with the pandemic, you have this creation of remote working and the ability to live in to uproot from where you work and live somewhere else. So just curious to get your thoughts about sort of this millennial generation who's kind of faced with this impossible decision. I can stay the city I'm living in, an increasingly smaller space or expensive space with worsening commutes, or I can sort of break the trend and move away or move out. And just to add one other data point from some of the research that you've shared is just that it seems like builders are sort of focused on these outside rings of cities. Maybe that's because where the land is. But anyway, what does that trend look like to you? Remote working, moving out of locations, millennials, what's that combination spell to you over the next few decades?
Well, let's give you some data that would help frame it historically and currently, let's say. So when the pandemic hit in 20, we had no question multi-generational living, young adults that were staying at home. In fact, it's pretty startling. I debate this with my kids as to why. But if you go back when I was, 1990 graduating college, you left after college. You didn't stay in your parents' house. And when you look at the number of framing it, further 18-year-olds, a lot of kids don't go to college, 18 to 24-year-olds in 1990, roughly 60% moved in a given year. Whereas today, roughly 32% of that cohort moves in a given year. And, my son is like, that's because we have so much mental health problems, Mom. And I'm like, no, it's because you're nurtured and everybody, it's okay for my kids to live there. And we have nice houses, and why leave? Because it's very expensive, and they'll save money, or I'll remodel my basement, like my girlfriend and her 26-year-old daughter is going to live there. So we are seeing that combination that's been prevalent for decades now. In fact, if you look at the number of 20 to 39-year-olds that are living at home today versus back in, we'll use 1990, 17% of that cohort lived at home. Whereas today, through 2010, we had 20% living at home. And based on the numbers through 2020, they are 24% of that cohort was living at home. So
Wow.
substantial increase. But interestingly, what happened was that during COVID, 2021 and 22, we saw decoupling, not only of young adults leaving home, which is one of the numbers I just cited, but also roommates decoupling. So we're forecasting now that by the end of 30, that will be 21% down from that peak of 24. But after COVID pretty much ended, the decoupling stopped. But don't forget, it wasn't just for more space and less density. It was also because they had free money, whether it was stimulus checks, Federal Reserve's policy to reduce interest rates to pretty much zero, allowing for people to buy with, it was like crack cocaine. Why not? Let's just go buy some houses. So that created this mass migration shift that became like, you're an idiot if you're staying in your cold / very expensive homes in the tri-state area in New York and or the Midwest. And why not buy a second home? And I'll go back and forth. But, remote work is not as accepted today. So I think that's starting to change the dynamics. And there's been some companies that have said you have to come back 100% of the time. I believe it was Amazon. Yeah. And that trend, assuming it unfolds, you might start to see more for sale signs become prevalent, because I don't necessarily think many just packed up and sold completely. I think they went to that second home route, especially the more affluent people.
Ivy, let's extend that trend that you just mentioned a little further to the first-time home buyers who are sitting out there looking at this market. It feels like we just described a bunch of reasons not to buy a house, right? There's the employers pulling me back in to the metro centers where I can't afford it and I've got to keep renting. And there's this low rate environment where there aren't for sale signs going up anyhow. At this point, do you think that social media trend around speed and the way that information gets passed among a generation, as well as the trends you just mentioned, are going to ultimately push first-time homebuyers out of the market altogether? I mean, we're seeing the numbers go down, but now what we've just described is a variety of pressure that basically says don't bother.
Actually, I don't, only because we continue to see pretty strong demand for first-time buyers. And what's happening is builders are sprawling further out. And we actually can measure that. I'm happy to share that in quantified terms. But, as builders are driving further out, drive to qualify, they're also providing pretty substantial incentives. So if you just look at the new construction market and what the builders have been prudently doing pretty aggressively starting in 22 after an initial, call it several months of getting pounded of weak results, they started buying mortgage rates down. So today, a first-time buyer might lock in as low as in the fours for 30 years. So for them, there's still that value. And therefore, if they're in a rental, like I, get on my soapbox here, we look at the inequality gap in this nation, it's only getting more severe. The poor are getting poorer, whether it's inflation and the cost of food and healthcare, insurance, everything's moving higher, which leaves them less discretionary dollars. The renter is more at risk of really getting squeezed. Whereas existing homeowners today, just look, for example, in statistics are providing data around that. If you are a renter today, what percent of renters are spending more than 30% of their income on their rent? It's about 52%. If you look at a homeowner today that's spending more than 30% on their home to make their mortgage payment, it's about 23%. So even if you're arguably an incremental homeowner, it might cost you more, but assumingly over time, home prices do appreciate. If you go through cycles, if you go back and look at GFC, where we are today, we're higher. But I think that what happens is that inequality gap widens if you don't have an asset. Think about the ways we create wealth. We own homes, they go up in value. That's our piggy bank. We can borrow against it. We have wealth creation. I have a girlfriend who lives in Utah, single mother, that raised 3 kids. And if it wasn't for her home that she bought, she would have no wealth to pass on to her kids. So I think that there is still the American dream and appreciating that. And also for those that are renters, another interesting stat, many don't invest in the stock market. So if you, for example, are looking at what percent of renters invest in the stock market, it's less than half of people that own homes. We've looked at that data. And interestingly, an average investment in the stock market by a renter is roughly $9,000. The average investment by a homeowner is $73,000. So think if you're a renter right now and you haven't participated in this great run up we've had in our market today, stock market indices, you're losing out. So I still would say being a homeowner longer term is a prudent decision. It might be that the builders will have to provide smaller square footage homes to create more value and lower price points. In fact, home prices are going down for new construction on average because of their further out and because they're providing smaller homes, with respect to square footage and taking a lot of bells and whistles out. So demand is good, but they need an incentive. The prospective homeowner is not buying a home at, call it 6.5%, 7% 30-year fixed. They're buying it with a rate buy down, or they would not be buying them.
So it sounds like in order to break this, I mean, there's always demand for home ownership. And I think you're right that demand is going to be omnipresent because it is the way people have built wealth. And so people are going to make trade-offs or figure out how to become homeowners. And those who are the most fortunate are going to be the ones that do it, but they're going to still have to make more trade-offs than say somebody in my Gen X generation would have made. They're going to make trade-offs on distance. They're going to make trade-offs in space.
I would just say, you talk about trade-offs. It's also things like maybe I can't go on vacation. I need to save, or I'm not going out to dinner a few times a week. So I think that discretionary dollars are more likely to be allocated to shelter or savings. But I was just thinking about the amount of wealth creation for our boomers and Generation X and how much wealth creation we've had. And that wealth transfer is happening. So while many young people today, first-time buyers, don't have, necessarily the wherewithal on their own, you're seeing that their parents and or grandparents and or family friends are helping them with down payments, or actually outright buying homes for their kids, and then maybe setting up a mortgage, or actually just buying homes for them. And we're seeing that happening today, but that's not big enough or across the board large enough to, accommodate everyone. But it is I think a tailwind to offsetting stretched affordability for some very fortunate people.
Yep. That's really interesting. And I'm very curious about this gray tsunami on the other side of the spectrum too, of like what that looks like over the next decade. But before getting to that, I mean, we often hear the term in the startup world that Jeremy and I sort of operate a lot in, of sort of house hacking tricks. And there are things like co-buying. I'm certainly seeing in some of the data that you've shared that more often are there multiple incomes in the single household. Are you optimistic that some of these interesting ways of buying homes or co-buying could be more prevalent as millennials try to find some way of getting into a home? Or do you think that'll still be marginal and overwhelmed by the fact that we actually do have a wealthy class of millennials that'll continue to be able to buy with or without parent support?
It's tough to say that it will accelerate from where it is today substantially, but I do think that, there is no question a trend for multiple earners. We see it in the data. Specifically, I can tell you that the amount of dual earners has accelerated roughly from, I'd say 57% or 59% of households have two earners today. And that's up like 400 basis points from, call it, a decade ago. So it's moving in that direction, really because of the inability to qualify on your own. So if you took the monthly payment as a percent of gross income, and you added the insurance and property taxes, which are 4% and 7% respectively of your income, you'd be at 59%. A single household income would be at 59% of your income. I mean, who can afford that for a medium priced home? Now, granted, if you have dual income, the average today, the household income is not twice the individual income. So a non-supervisory employee is making, call it, close to $55,000 a year. The dual income or household income is like 81,000. But to actually purchase a first-time home that's at the median home price, you need 104,000. So even a dual earning homeowner could not afford that house, or a dual earner, let's say renter, couldn't afford it. So it's almost by force that you're going to see an acceleration in the number of households that have multiple earners, whether they're related or they're friends. I think that trend it's slow though. I mentioned 400 basis points, and it's not like going nuts, but that's not insignificant either.
Mm-hmm. Ivy, can we pivot to just a couple of quick things that are going on in the world, and we can find out your take on them? One of the things that we talk about a lot in the housing finance mortgage side is everyone always talks about the cost of origination of a mortgage and the cost per transaction for the individual consumer in and out of the house. And yet it always goes up. And we continue to hand wring at the MBA about the cost, but nobody's ever lowered it. What's your take on placing bets on how the cost of the transaction changes or doesn't with the introduction of emerging technology or any other trend you see over the next, say, 3 to 5 years?
As we've always, I guess, seen, whether it's TVs or, any type of media and, various technological innovation is always reduced, been deflationary, whether it's our computer or our TVs or media technology. So I'd imagine that you would expect to see it come down, but I'm definitely not an expert on that. But I would assume if that trend is prevalent elsewhere, it should be prevalent with technology and mortgage origination.
I was going to pivot to sort of another area that there's been a lot of discussion. Ivy, I'm sure you're paying attention to this trend, which is the NAR settlement was supposed to have some potentially major ramifications in the world of home buying and selling. What's your take? Are we going to see a major change or compression in commission?
I think, first of all, really haven't seen much of an impact at all year to date or since it's been implemented. I think that what's interesting is that many of the realtors will have a conversation with a prospective buyer. Look, we need to disclose to you that if the seller won't provide you any type of the commission, they won't provide the commission that I would need to earn, then you need to do it. And here's what it's going to cost you. We need to sign this, or we need to agree on that up front. And yet the seller is likely to still provide it in some fashion. So it's really about transparency. And what's happening, which is interesting, despite that fact that it's an incremental cost to a prospective buyer, if now they have to pay the commission, which is going the wrong way with respect to allowing for affordability to improve, we're actually seeing some cases commissions incrementally higher because now we have realtors that's making the full commission from the seller, which might be 5%, and the buyer realtors also getting a 3% commission. So that actually could result in higher commissions, which we hadn't thought of that would be the case. But I still think that the disclosures today, while providing transparency, if someone wants to sell their house, the discussion the realtor is having is that you really need to provide an incentive to sell this house to your prospective buyer. So I would encourage you to still find a way to, whether it's reducing the sales price by a certain amount or finding a way to pay that realtor, pay the commission for the buyer's retail. One thing I was going to mention that you didn't ask me in the first question you asked me is what are you watching? What do you care about that maybe no one's talking about? The one thing, if we go back to first-time buyers and people today that have been the beneficiary of the free money and, where stimulus and rates were, we're seeing a relatively large increase in first-time buyer delinquencies. And one of the things that we've been watching on the mortgage front is that basically, the Ginnie Mae product allows for people to have a back-end ratio above 50%. So if you look at the data through 2004 year to date, what percent of homeowners today that have a Ginnie Mae mortgage have a back-end ratio, which is your total debt, your car payment, your mortgage payment, your credit cards as a percent of income? 12% are above 50 on that back-end ratio. And just comparing that back to, let's say, 2020, it was 7% pre-COVID on a 2Q. So just looking at that, it's really concerning. And then you fast forward and then look at the delinquency rates of what's happening in 2024, and they're going delinquent faster to 30 days, and the percent that are going delinquent is much higher than prior vintages. So I think it's worth noting that that's an important trend that we're also watching. And obviously the NAR settlement and trying to understand what the implications there. I think this is a bigger issue than what the commission rates are going to do for realtors. It is shedding underperforming realtors, though. No question that, the guy who's on Zillow buys a lead and shows up at the door to represent a buyer and says, you have to pay me. He's like, I thought you were the seller's agent. See ya. That's happening a lot too. And those guys are not going to survive.
Yeah, it sounds like disruption leads to consolidation again. That's sort of a pretty standard pattern there. One of the things you mentioned throughout that is obviously critical is home builders and how home builders play into all this. And your data is strong indicating those trends where they're going. We've also seen an uptick in the conversation around new innovative offsite or factory built types, other types of innovative home manufacturing. What's your bet or what's your view going forward on offsite construction, factory built housing, or some of the other smaller, your data's been leading on public builders getting bigger, right? That's your trend that you've identified. What do you see on the smaller builders or some of those new innovative types?
I think it will remain a relatively small percent of the market. I know builders that are building with modular housing now that are successfully offering that type of product, but I don't think that, this dinosaur industry can get off of their current supply chain / vendors and trades the way it's set up. Nobody wants to take the risk that I'm going to rely on, put all my eggs in one basket and rely on this factory to provide me what I need and give up my trades. And if labor's short, I don't want to get rid of those relationships or discontinue them. So I think it's really unlikely that we'll see that innovation accelerate. I do think that it's prevalent, but it's very small. In fact, I was chatting with one of the largest builders and they were coming to my housing summit. And I said, do you think we should have, one of the modular / factory built? And they said, nothing's going anywhere. Like, no, nothing's happening today that's worth talking about. So today it feels like it's really, especially post Katerra, where that was a big flop. I think there's been less focus, less innovation. There's some 3D printing that's happening, but it's on very small scale.
Yeah, I'm wearing my Icon hat right now, and I agree
Yeah,
with
there you
on a
go.
small scale. And I'm actually really curious to know what will it really take for offsite construction to be meaningful in this industry. But one area that also gets a lot of attention lately is, and this is probably one of the few areas that I think will ever see success on zoning policy, which is allowing for ADUs, kind of creating a new opportunity for density. Are you bearish, bullish on the idea of creating more ADUs in the industry?
Well, I think it makes sense in those markets where, whether it's the California MSAs, where affordability is well beyond even the numbers I cited and much less achievable for many. I think it makes sense, but I don't know that many will need that in other markets throughout the country. I think it's very much maybe more focused in markets where it's beyond unaffordable. And it makes sense, if you have ADUs in someone's backyard and they own a few acres and they're willing to provide that. It's much more of a Millennial Gen Z type, probably today prospective ADU buyer. It wouldn't be someone like you or I that are going to do that.
Right. I've got 3 of them in my neighbors' backyards here, and I imagine
really?
you don't have very many in Cleveland.
No, we don't.
Where I doubt it's going to be a prevalent trend.
Ivy, thank you so much for joining us. I've had so much respect for you from a distance, and thank you for sharing your insights with us. I wanted to ask you the last question, which is, what do you see as the business that should exist today, the business you wish would exist today, or the company you would start today if you could give that recommendation to a founder? What do you think that would be?
Well, I still am a, proponent for new construction. I do think that the problem is the impediments that exist today that we'd have to find a way to eliminate to make it more profitable and more beneficial to prospective buyers. But I do think that longer term, it's cyclical, but real estate developers, where is wealth created? It's real estate owners and developers. There's serious wealth there. So I wouldn't dismiss it. I think it's a legitimate business that has significant potential, but we need to reduce the impediments. And a lot of those surround what local governments can do. So, for example, impact fees today represent 5 to 10% of the average selling price. And that's really pushing costs that are local governments to the developers, which is really unfair for them to have to pick up all those costs and just the NIMBYs and what they don't want developed. And I think we get rid of some of those impediments and we can provide more affordable housing, whether it's government subsidized, it can be very successful, very, I think, lucrative business.
I love that answer. I've always said to people that are in housing policy, if all the people talking about how much supply we need would actually just go out and develop houses, we wouldn't have a supply problem. And so I love the recommendation. Ivy, I will echo Jeremy's thanks. Great to see you again. Appreciate you taking the time. Thanks to everyone who's listening. Please subscribe and pass this along to all your friends. We really appreciate it.
Great. Thanks for having me, guys. Happy holidays.